Hey there, folks. Greg Shepard here, S&A Financial Services. In today's video, I'm going to share with you what not to do. How about that? So I ran across one of you all out there, found me on YouTube, contacted me. I did a one-time TIAA optimization game plan. Quickly found that her current advisor, well, ex-advisor, was giving her just terrible advice. Maybe unbeknownst to the advisor, maybe beknownst to him, but nonetheless, getting terrible advice. She came on board as a client. We fixed her situation. So I want to share this with you via a video because I know this is going to pertain to a lot of you out there, some of you out there, okay? So let's try to avoid these things. I'm going to share with you maybe how to avoid these things, okay? So again, name is Greg Shepard. I do specialize in helping folks all over the country just navigate those troubled waters that you find yourself in with these TIAA accounts, okay? Before we get going, I do want to thank a few of you out there. On my last video, when I'm doing these real case scenarios, I asked, is there a better way to record these videos? Because my software obviously is in a delay. And a few of you reached out and said, hey, just record it through PowerPoint. I didn't have a clue that was even a thing. Looked it up, and sure enough, it is. So this is my first time doing it. Hopefully I don't run into any complications. But as I said last time, I'm not an IT wizard. There's only so much I can do, right, folks? And I try to do it well. Okay, so let me set the stage here. I'll piggyback off what I said earlier. This is a person, a single lady, 70 years old, as you can see by the input right here. 70-year-old lady reached out to me, found me on YouTube, retiring next year. We did a TIAA optimization game plan. She's since onboarded as a client, figured out she can't do all this by herself, which is perfectly fine. And I found out real quick that the advice she was getting, and some of it a little, it's not too late, but I'll get to what I'm talking about. Just wasn't good. It wasn't in the best interest of the client, in this case, Marianne Ellis. Now, for you all out there, you got to be cognizant of the fact that, so, how do I word this? So the advisor, the independent advisors out there outside of TIAA, I tell you what, some of them, there's bad apples in every industry. Not saying that this one was a bad apple, but that advisor can't charge a fee on assets inside TIAA. Okay, they can't take it directly from the account. So what I've seen in my 26-year career dealing with TIAA and outside advisors is that a lot of advisors will try to figure out how to extract the monies from TIAA as quickly as possible. Why? Because when they get the monies out of TIAA, they custody over a Schwab. TIAA doesn't matter where, Fidelity, Schwab, somewhere outside of TIAA, they can charge a fee fee deduct directly from the account. They can't do that over at TIAA, okay? So my advice in that regard, ask the advisor to justify mathematically as to why he or she, the advisor, is choosing the path that they're setting you upon, okay? So I do that, and I can easily justify all my decisions that we make. Now, with that being said, okay, so what we're going to do here, the goal in this PowerPoint presentation is that I'm going to show you two different scenarios. One, the scenario, the path that her old advisor was going to take her down, which wasn't a terrible path, but nonetheless, the path that the advisor was going to take her on. And I'm going to share with you the trouble that they were going to encounter in the near future, RMD age, okay? And then we're going to compare it to scenario number two, the one that we ultimately are going to choose. We haven't really, so we're going to choose it, but we might modify it a little bit, okay? So let's get going here. Okay, and I'll probably repeat some of the things I just said, but we've got a 70-year-old single lady retiring September, basically in 1 year. Okay, so this is one of the problems that we found ourselves in, that she found herself in. Right here, this first variable, okay? Existing IH. So that's a 10-year TPA. So she already enacted or initiated a 10-year TPA. I think it's like $53,000 or thereabouts. And we'll pause there because the only way you can initiate a 10-year TPA for a contract that you're currently employed, so the 10-year TPA came from a contract from her current employer, okay? So you have to do a 10-year TPA to reinvest. Now, where that became a problem is that what this advisor was going to do is redirect that 10-year TPA once she separates service and direct it to a rollover IRA. Okay, we do it all the time, but was that in her best interest? So let's move on. So we got existing IH and GSRA are the only monies that have traditional in it. Okay, her payout rate for lifetime income with only the GSRA traditional and that IH contract. Okay, the GSRA is liquid, was 9.5%. That's when my eyebrows went up. That's a good payout rate. Now, again, we'll pause there. A little strategy or nuance to that 10-year TPA that a lot of people don't realize is like for this scenario, even though we've initiated, or she before me initiated the 10-year TPA on that traditional money, so that's a contract that's you have to, the only way you can get out of the 10-year TPA is if you initiate lifetime income on those monies. That's it. See, TIAA wants you to do the lifetime income. Nothing wrong with that, but they'd like you to do that. So that's the only way you can get out of that 10-year TPA. You can redirect where that 10-year TPA goes, but it's irrevocable other than flipping it to traditional lifetime income, okay? So we'll get to that here in just a bit, but the payout rate for lifetime income is 9.5%, which is a very advantageous rate. New deposits going into traditional and then transitioning into lifetime income, 8.5%, which again is a favorable rate. All non-lifetime income assets, we're going to transfer that to Charles Schwab. That's the goal. To a rollover IRA, these are all pre-tax monies. Let's move on. Okay. So let's make sure we can navigate through this. Okay, we got the active 10-year TPA. I said it was 53,000, but it's a little off. 51,800 is what's currently left in traditional going through that 10-year TPA. She had 9 more payments on that, by the way. So I may have alluded to this earlier. Again, let's pause there because this is where the problems come into play. Her RMD age is 73, okay? Without getting into a lot of the nuances of this, what she is going to have to encounter at some point in the future is that the advisor was going to kick out the 10-year TPA once she separates service annually to the rollover IRA, okay? But once she hits RMD age, TIAA is going to say, hey, you're RMD age, we got to kick you money, you being Marianne in this case. So what this individual is going to have to do is transition those monies into an MDO. Well, okay, let's back up. So once you separate service, the advisor is going to do a 10-year TPA to wherever, Fidelity IRA. TIAA is going to say, hey, you're RMD age, okay, so we got to kick you money out. So you're going to have to do a TPA to reinvest back into the contract from which it came, even though she separated service, okay? Then you flip it over into an MDO, minimum distribution option, same thing as RMD. And anything left over outside of the MDO, you can then manually transfer it over to a rollover IRA and then do it all over again next year, okay? We do it all the time. It's just a logistical headache. You can accomplish it, but it ain't fun, okay? Just note that. Okay, so you can see the values here. We got an RC and RCP, all in the same employer, if I haven't mentioned that. She's been there her whole career. So we got RC, RCP, GSRA, then an RA contract. So total is 1.8. The only traditional outside of the IH right here is in the GSRA, which again is liquid. You got 73,500 sitting there in liquid. So 125,300 in traditional. Okay, moving on here. IH is already paying. Consolidated Schwab for monies outside of TIAA. Okay, let's just move on from this. Okay. So again, scenario 1 versus scenario 2. Scenario 1, portfolio income only. This is what that advisor wanted to do. Nothing, I was going to say nothing wrong with it, but we want to make sure we're doing something in the best interest of the client, okay? So he was going to redirect the IH TPA payments to Schwab once, Fidelity, I think, actually. Once the individual, in this case, Marianne, separates service. You have to wait until that event transpires to do so, and then transfer all other assets to Schwab. So this would get the client, Marianne, about $113,000 because the goal, as I didn't know what the goal was, so this would be my goal, okay, in scenario 1, is to extract the interest being generated by the portfolio, which would account for around $113,000 without touching principal, okay? Scenario 2, this is where I came into play, okay? We're going to convert IH and GSRA traditional to lifetime income. Why? Because it was a 9.5% payout rate. Move 150. So then her eyes lit up because she didn't know any of this. Okay. So then I even went further, and I don't normally do this. This is why I stress the fact that every situation is different. So I said, Marianne, even that new deposit going into traditional for purposes of lifetime income is attractive, 8.5%. So we're going to move $150,000 from her liquid money in the RA contract into traditional for future lifetime income. She's going to get around $124,000, $125,000 of gross income in this strategy. Okay, so let's keep going. Okay, scenario one. Just kind of reiterates these. So IH TPA payments, going to redirect it to Schwab. Oh, she was going to choose on all lifetime income, a single life annuity option, 10-year guarantee. We kind of talked about this. She's single, no kids. She has someone. So she's 7. The cost of that insurance, so to speak, wasn't very expensive, that 10-year guarantee. So she felt comfortable doing that. I don't know if I agreed with it. It's not irrelevant, but it didn't cost her very much. So we went ahead and tacked on the 10-year guarantee. Again, $113,000 there. Other TIAA assets. And if I didn't mention this, we're accounting for 6.5% on the interest being generated on the rollover IRA, pre-tax monies, okay? And that's the monies that we're taking out for income purposes. Okay, so scenario one, we got LTI, lifetime income, 0. Let's go back. Oops, can't go back. Okay, lifetime income is 0. That's one thing I just learned about PowerPoint. I can't go back to the previous slide. Okay, so better make sure I complete everything before I move on to the next slide. Okay, the rollover IRA income, $113,000. I think we're finished with this slide. Okay, scenario two, we got a combo here. Lifetime income, we're going to flip that IH and the GSRA. You're going to get about $12,000 from that bucket of money. Remember, that's like 9.5%. And they're going to add what we came up with, $150,000. We didn't grab it out of thin air. We kind of wanted to double her amount from 12 to 24-ish, and we accomplished that. So we added $150,000 in the RA contract to traditional, and she's going to get about $12,800, $13,000 thereabouts gross annually. Oh, something else. So I need to emphasize this. So she lives in the state of Kansas. Okay. I don't know how many states there are that abide by this rule. I know New York's one of them, which is a heavy taxed state. But there are some states out there that lifetime income, these annuity payments coming to you for purposes of income, are not taxed on the state side. Okay, it's pretty important. It's not a huge deal. It doesn't really dictate one decision over the next. In some states it might, but like Kansas, it's saving her some money basically, okay, on the taxes. All right, so just know that. Is your state one of those states? I don't know. You got to look it up. All right, or email me and I can tell you. Okay, so there's the lifetime income, okay? And then the rest of the money over here, again, scenario two, is the rollover IRA. We're taking money, the interest being generated by the rollover IRA for income. Okay, so we're getting about $24,000, $25,000 of LTI lifetime income, about $100,000 from the Schwab rollover IRA, okay? And we're going to get together about $125,000 of gross income, which is higher than probably on the next slide here. Yeah, so I like 124,700. I like it more than 113. Not only that, she is not the best with money, so this makes her comfortable, makes her feel comfortable knowing that she has a floor of, what was it, 20 some odd, $24,000 of lifetime income coming to her. Obviously, scenario two is going to get her about 12,000 more per year. Okay, so we opted for scenario two if you haven't figured that out yet. And okay, so yeah, $25,000 of lifetime income just kind of reiterates some of the inputs, and that probably is it. Okay. Okay, that's just kind of a summary here. So what I want to get across to you all is I'll reiterate the fact that even though your financial advisor, the independent advisor, he or she may be wonderful people, they probably are, but they just don't know all the nuances associated with TIAA. You need to make sure that what he or she is prescribing for your future health is backed up by math. Okay, now I always say there's a human side and a mathematical side. We don't always choose the best mathematical path for various reasons, but you got to know those reasons. Okay, the more educated you are, obviously the more educated decision you can make. Again, if you have any questions of your situation, by all means, contact me and I'll get you squared away. All right, Greg Shepard here, S&A Financial Services. Hey, you all take care. Bye-bye.